Okay, Professor Jim Schultz here from my Finance 512 class. As we talked about it last night in class, I wanted to go ahead and shoot this video for the Facebook earnings call that's later on today. And so we'll go ahead and get into that in a second. But I did want to recap. As we talked about yesterday, I did a strangle in Twitter because Twitter had earnings yesterday. And I went ahead and closed that guy out this morning. And so I'll kind of show you guys the recap of that real quick. So here's my Twitter position. If you notice, if I click the blue arrow, it says that my quantity is 0. And so that is another way, as we talked about in class, to, as you're learning this stuff for the first time and you're trying to square up your positions successfully, you probably want to double check that your quantity is back to 0 when you think it should be. So if you notice, I made 116 bucks on Twitter today, and so that was on a one lot. And so we will. The rest of the day is not going too terrific, but that's okay. Let's focus on the positive. Let's stay focused on the positive here. And so I want to walk through exactly how that happened, so you guys can kind of see how an earnings play works and that kind of stuff. So what I'm going to do is I'm going to go to my account statement, and I'm going to. This was the trade this morning, but what I'm going to do is I'm going to go 2 days back. And I only want to look at Twitter, just so you guys can exactly see how everything worked. So yesterday at 14:40, so at 2:40, I went ahead and sold this strangle in Twitter, and I picked up a credit of $2.02. And so I sold the call for $1.17. I sold the put for 85 cents. I picked up a total credit of just over $2. This was my maximum gain on the position. Now this morning, I wanted to close it at 9:31, but I was a little distracted and it took me a few extra minutes. And so I went ahead and wrapped this guy up at 9:36 this morning. Twitter opened at around $43. And so when I put on this strangle, Twitter was like $48.50, and this morning it opened at about 43. So it was definitely challenging my lower break-even point on the put side, but it hadn't quite gotten there. And because it stayed within my range, I was able to make some money on this trade. And so I was able to buy this whole thing back for 75 cents. So that puts my total profit at, what, $1.27. And so a pretty nice trade. I'm pretty happy with that. And this is one way, or this is one example of a successful earnings strangle. And so I kind of hope, so let's transition into Facebook now. So let's go to the trade tab. I've already kind of loaded up Facebook. And so I really kind of hope that this Facebook trade doesn't work out, because I want you guys to see what happens when these things go wrong. I don't want you guys to walk away thinking that, oh, it's easy money. All I have to do is earning strangles for the rest of my life. I can quit my job. I can drop out of school, and this is all I'm going to do, because that is absolutely not the case. And so the Twitter thing worked out, but let's go ahead and fire up Facebook and kind of see what's going on. One thing that's a little sticky about the software that I want to point out on today's option statistics, sometimes it takes a minute for Thinkorswim to load up the options stats on a given stock, and so this should populate in the next few minutes. There we go. Okay, so for Facebook, the implied volatility of Facebook is 43%. Okay, so again, that's the weighted average implied volatility. So what I'm going to do right now, you see the market, you see the current price of Facebook is $80.77. The market maker move is $5.40. We talked about this last night, right? That's basically the expected overnight move in Facebook. Which, remember, the overnight move in Twitter was about $6, and it moved about $6. And so this stuff is kind of amazing, right? I mean, these market makers, they know what they're doing, obviously, right? And so what am I going to do? I'm going to do pretty much the same thing I did yesterday in Twitter, because you guys didn't see how I did that in real time. You guys just saw the end product. So let's go ahead and do another strangle in Facebook for these earnings that come out after the bell today. Now, you guys, as I've instructed in class, you guys, it's a lot easier if you just use standard option contracts as you're learning. So you use the No 14, the D's 14, right? This will be your front month, this will be your back month. I am actually going to use this October 5 weekly option. The weekly options rather than expiring on the third Friday of every month, the weekly options expire every Friday. And so the Oct 5 means the 5th Friday in October, which is this Friday, which is Halloween. The Nov 1 is the first Friday in November. The Nov 2 is the second Friday in November, and so on and so forth. So I'm going to use these weekly options only because when you're trading earnings calls, you actually want to use, and I don't have time in this video to get into all the reasons why. But like I keep saying in class, check out Tasty Trade because those guys are amazing, and they have videos dedicated to earnings calls and all these things, and they'll go into more detail actually. But you actually want to use the contracts that are closest to expiration. You don't want there to be a lot of time. You actually don't want there to be too much time value pumped into the option. You kind of want it to be kind of a cleaner trade. So okay, so we're at 80.78. So that puts my at the money option at about 81. Which now, surprisingly, I've got a delta of about 50. I've got a delta of about minus 50, exactly as we've learned in class, right? Okay, so what am I gonna do? I'm gonna make Facebook beat me, right? Twitter couldn't beat me, and so I set up my strangle just outside the expected move, and Twitter was unable to beat me. And like I said, for these earnings calls, most stocks will not beat you. More times than not, the stock will not beat you. That's what makes these earnings plays profitable over the long term. Now, every once in a while, like I had an earnings call. This was in April of this year. I put on a let me think. It was not a strangle. It was not neutral. It was a directional. I think it was a put spread in Whole Foods. I put on a put spread in Whole Foods. I sold a put spread, so it was a bullish strategy. Whole Foods reported earnings. Whole Foods fell 20% overnight. 20%, like blew away the expected move. And so that position hit maximum loss immediately. But fortunately for me, I had sold a put spread, so it was a defined risk position. And so my losses were capped. I'm very lucky that it was not a strangle or a straddle, because then I would have had, to spend months and months and months trying to manage that trade to bring it back anywhere near even or even to a respectable loss. Okay, so let's get into this strangle. So 530. So, I'm going to be kind of approximate here. That's about 530. That's about 80.70. So 80.70 plus 530 is 86. So what I'm going to do is I'm going to go ahead and sell the 86 call. So we'll load that guy up there. Sell the 86 call. And then let's see. 80.70 minus 530 is going to take me down to about 85.50. So, or 75.50. And so I'm just going to use the 75 put. It'll be a little bit outside the expected range, but that's okay. So again, hold down control, sell. And let me point something out real quick before I do this. Look at the spreads in Facebook. 1 penny, 2 pennies, 3 pennies. I mean, in the options world, as you guys start trading options, you'll notice that the spreads in the options world, you're lucky to find something that's less than a nickel, right? And so when you've got these, highly liquid stocks like Facebook, you can trade this thing like water, man. That's what makes it such an attractive underlying to trade in terms of options, because it's just so liquid and you can get great fills on Facebook, right? So I'm going to press control. Okay, so $1.73 credit. So let's take a look at this. So what's my mid price right there? 78.5. What's my mid price right there? 94.5. Or now it's 94. So what is 94 plus 78? That is $1.72. 94 and 78 is $1.72 exactly. So like I talked about in class, I've got my credit set up right now at the midpoint of essentially the bid and the ask on both sides. So I'm only going to do a one lot, because when I trade in my paper money account, I try to simulate real life, and I know that in real life I would not be doing anything more than a one lot strangle in Facebook for earnings. Even that'll make the hair on my neck stand up. So that'll be plenty for me. So let's go ahead and we'll lock this in, lock the price in so it doesn't float anymore. Let's go ahead and see if we can get filled. And go from there. So there's my strangle. Confirm and send. Maximum profit is the credit. Maximum loss negative infinity, as we've talked about in class. And then obviously you've got your commissions to put the trade on. Let's go ahead and send it, and boom, you get filled immediately at the mid price. And so, like I said, when you deal with these highly liquid instruments, there are some significant advantages to doing that, because they're so active. You're going to get really good prices on those trades. And so that's it. So now we've got, I go to monitor activity and positions. Boom, I am in Facebook, and you open up your blue arrow there. I am short a 75 put. I am short an 86 call, right? And so yeah, just like I did with Twitter this morning, I will look to close this guy, for better or worse, tomorrow morning at about 9:31, 9:32. And so I'll get this video uploaded for you guys. It's 10:30 a.m. Give me a couple hours. I should be able to get this out to you guys by noon 30, something like that. So all right, guys, that's it. That's our earnings play in Facebook. Good luck.